The stock market is a giant distraction from the business of investing. I love that quote from John Bogle. So, accumulating wealth is quite easy. You identify quality assets, you invest early and often, and you take advantage of the snowball effect. So, today's presentation is actually really interesting, and we do a lot of examples that show how accumulating wealth over time works with the snowball effect. And before we get into that, I just want to go over some basics. So in everyone's investing journey, they're going to at some point come up to this question of lump sum investing versus dollar cost averaging. The idea there is if you have a bunch of money, which usually most people don't, do you invest that into the market slowly over time, or do you do it all at once? And slowly over time would be you pick a fixed date of every month and you invest a certain amount and you pick a time frame, etc. So most of the research points to lump sum being better. Why is that? That's because cash provides a drag on your returns. The old statement, it's about time in the market, not timing the market. Exactly. So in most cases, however, dollar cost averaging is how wealth gets created. This is why we utilize it and we encourage people to do the same. And that's because in a typical investment journey, someone's going to have monthly contributions. Sure, they may have year-end bonuses. And I remember when I was in that situation, I would invest my bonuses fairly quickly across my portfolio of assets. And then you have things like an inheritance or a windfall of money, good problems to have. But the takeaway here is that most newbie investors getting started out, unless they come to the table with wealth, they're going to be using dollar cost averaging. They're going to be investing a little bit every month. And in the case of our tech portfolio, when we trim positions, that's actually a form of reverse dollar cost averaging, right? So here are some assumptions we're going to make before we get into today's examples. You're always going to start off with $10,000. I think that's a reasonable amount of money that someone could accumulate. And then once you have that to invest, you're then going to invest anywhere from $100 a month to $1,000 a month. That's pretty reasonable to think that you should be able to do that. Now, when we think about returns, today we're going to be talking a lot about how much money you can make, returns. We're going to have 3 return profiles. Total return, so this is where you make an investment in an asset, it's paying you dividends, and you spend those dividends as you receive them. So that does not achieve the desired snowball effect. Then you have total return with dividends reinvested. So that means every time you get dividends in your portfolio, so for any stock or ETF, that typically happens 4 times a year, you reinvest those dividends right away. Most brokerage firms let you do that. It's called a DRIP, dividend reinvestment plan. And you go and there's a little checkbox that says reinvest dividends. It automatically does that for you. Fractional share amounts. Then you have this idea of sweetening the pot with monthly contributions. So not only are you reinvesting dividends 4 times a year, but you're also investing every month. This idea of invest early and often. So the snowball effect is the compounding effect of investing very frequently. So many assets produce some income yield. Even SPY, the notorious S&P 500 ETF, has a yield associated with it. So the companies in the S&P 500 that pay dividends, those get paid to holders of SPY. So a simple S&P 500 ETF even will produce income, and then you reinvest that income as it happens. That reinvested income then produces more income. More income means more money over time, and now you see the effects of a snowball. So the further along that you get on this plan, the more money that you have in an exponential fashion, not a linear fashion. So today we're going to look at quite a few interesting examples, and we took these from a tool built by these folks, SRL. I wasn't aware of this tool, but Probos in our Discord community pointed me to this, and apparently everybody knows about it except me. That's one of the benefits of having a community and the network effect. So the odds that we miss something decrease as we scale. So he pointed me to this tool here, and actually there's quite a few tools from this firm, SRL. And the one in question that I used today is the Backtest Portfolio tool. It's really slick. I had to give them my email address to be able to use it appropriately, but it's completely free, unless, of course, you want to do some crazy things with it. And they have a lot of other interesting tools as well. So before we start looking at some very cool examples, I just wanted to ask if you can throw us a bone. We need your help in supporting this channel. In order to do that, if you're just watching this video for the first time, please subscribe. If you're a regular subscriber to our channel, please sign up to our newsletter. There's a link in the comments section. So let's start out with our first example here. 20 years invested in the S&P 500. So from 2003 to 2023, so I wanted to make sure I had 20 full years. We're going to invest $10,000, and we're not going to reinvest the dividends. And what we end up with after 20 years is $53,872. All right, so we made some money. But here's what's important to pay attention to. Remember, I talked about how the S&P 500 ETF pays dividends. The dividends that you're receiving now represent, and you can see that in the table on the right here, you see that income, $752? Well, that's a 7.52% yield on cost. That's the original $10,000 we invested now produces 7.52% every year, and that's growing over time. Now, the question is this. What if we, over that 20 years, reinvested the dividends? Okay, let's take a look at that. What we end up with is about $26,451 more just by reinvesting those dividends. And that original $10,000 now produces 11.11% yield on cost. See the income on the right there? So that's not very much, but it's still notable. Now, here's where things start to get more interesting. What happens if we invest $100 a month over that same time frame, over that 20 years, and we're reinvesting dividends? Let's take a look. So that would mean we would invest $24,000 over 20 years, plus the initial $10,000. So simply investing $100 a month over that time frame brought in an additional $93,116 for the $24,000 that we invested. That total amount that we invested, so the $10,000 we initially put down, the $100 a month for 20 years, that's $34,000. That now produces 7% yield on cost. So look at the income there on the right. That's pretty decent. We have $173,000. We're making about $200 a month. Now, what if we kicked this up a notch, okay? What if we invested $1,000 a month? Well, congratulations, because you're now a millionaire. So simply investing $1,000 a month into the S&P 500 with that initial $10,000, you now have a couple of things. First of all, you have over $1 million, so that's notable. But you're also producing over $1,000 a month in passive income. Not much thought was required here for you to become a millionaire and have $1,000 in passive income that's now being presumably invested right back into buying more SPY. So the takeaway here is that benchmarks offer an easy, largely predictable path to wealth. Now, a couple things. First of all, people will bring up inflation. Well, here's how we counted for that. So you know that $1,000 a month? Let's say that amount that you're putting in over time, the $1,000 a month, increases to account for inflation. That should be very easy to do, so then it all works itself out in the end, right? So the next thing that people might say is, well, what about stock picking? So what happens if we start deviating away from the S&P 500 ETF SPY and we start looking at investing in specific stocks? For example, this dividend king we covered recently here, Parker Hannifin, that's been one of our strongest dividend growth stock performers over time. Well, let's run the numbers. So let's do 20 years here without dividends reinvested and look at total return. So you can see over 20 years, Parker Hannifin's produced $149,805 versus the $10,000 we invested. And the SPY has simply produced $53,000. So you've made a lot more. But what if we took into account dividends? And look at this. So with Parker Hannifin reinvesting dividends over time, we now have an additional $63,718 versus doing the same for SPY gives us only an additional $26,541. Furthermore, at the end of that 20 years, we now have, and this is only with that $10,000, you now have $221 a month coming in passive income from Parker Hannifin versus $63 a month from the S&P 500 SPY ETF. Why is that? Well, this is all about dividend growth. All right. This is the snowball effect, the power of reinvesting money, an income stream that's growing over time, the compounding effect. All right. Here's what happens when we invest $100 a month into Parker Hannifin. And you see here that we invested our initial $10,000 and we put $100 a month. On the left column there you see is portfolio one, that's Parker Hannifin. On the right is SPY. So that $34,000, the $10,000 initial dollars, and then the $100 a month, $24,000, so $34,000 total. That now turns into $400,915, and we have a monthly income of $414. It's a yield on cost for our money invested of 14.6%. Where's all this money coming from? This is the power of dividend growth. Now, this is rather surprising. So I took SPY, the popular S&P 500 ETF, and I looked at the dividends it pays over time. And it actually is fairly decent. So 6.9% growth over 20 years isn't bad. Now, you see it's somewhat unpredictable. It's not consistently growing over time. You see that minus 20% dip, that would have taken a hit on your income there. So when you look at another example here, so this is Illinois Toolworks. We did a piece on them recently which looked at the idea of total return. Illinois Toolworks has performed quite well, and look at how their dividend grows over time. Because it's a dividend champion, it's actually a dividend king. They've increased their dividend for over 50 years. So just in the past 20 years, of course, you expect to see it increase every year. It does. And their increase over that 20 years is 12% every year. So that makes a big difference when it comes down to total return. Here you can see Illinois Toolworks against the SPY ETF. And what we would expect, of course, is to see that it's outperformed. So $129,000 versus $80,000 from SPY. It's also producing, this is very important, $220 a month versus $65 a month for SPY. And that's the power of dividend growth. Now, I can hear people saying, but Joe, I don't have a Romanian fortune teller that can help me pick stocks to generate alpha. Well, fair enough. What we can then do is consider a 10-stock dividend growth portfolio. Let's simply take the top 10 stocks in our Quantigence report. So anybody that's a paying subscriber has access to this report. Take the top 10 highest ranked stocks. Here's the breakdown of sector. So interestingly enough, you can see that tech is not represented. We have overexposure in staples, energy, healthcare, industrials. All right. Let's take those 10 stocks and then let's see what they look like over time. So let's start out with the $10,000 invested over 20 years, and they handily outperform SPY, generating $123,000 in return versus SPY at $80,000. But here's the kicker. They're now generating $218 a month in passive income versus the $65 a month from SPY. This is the power of dividend growth. Now, what we can then do is say we have a 10-stock portfolio. Let's put $100 in each stock every month. That's $1,000 a month, all right? That's not very much. Most people, if they work in a developed market and they hustle and live below their means, ought to be able to sock away $1,000 a month. Now, here's what that looks like. So, investing that $1,000 a month into our portfolio versus $1,000 a month into SPY, the S&P 500 ETF, we, after 20 years, would be generating $2,121 a month in passive income versus $1,100 from SPY, and we'd have $195,000 in extra money. Now, that's 20 years. If we tack on another 10 years, we can really see the snowball effect come into play. So 30 years, I think that's a realistic time frame for somebody to be investing in throughout their lifetime. Here you can see that dividend growth portfolio after 30 years would be producing $5,366 a month in passive income versus less than half of that from SPY. So SPY would be producing $2,424. Even better is that you'd have an extra $722,677 versus SPY. So the takeaway here is that dividend growth, the power of dividend growth, and investing regularly and often can generate wealth quite easily. As they say, you can become an instant millionaire after 20 years of hard work. So invest $1,000 a month in SPY or a 3 ETF portfolio or your own DGI portfolio, as we've shown in today's examples. Reinvest all those dividends, wait 20 years, and you'll be sitting pretty. So there's some parting thoughts here. You can always torture the data and make it say anything, so you can include more assets, less assets, cherry pick your time frames. But generally speaking, across all the research we've done, dividend growth investing, when an investor is reinvesting dividends and contributing to that portfolio over time, can show very superior results. Of course, past performance is not a guarantee of future performance. And the snowball effect, what you've seen today, based on the examples we've looked at, really works best for dividend growth stocks. And it also works pretty well for a simple broad market ETF as well. So make sure that you invest early and often. So if you're interested in creating your own great dividend portfolio, we did a video on that you can watch next. Please make sure to subscribe to our channel, support our work. Thanks so much for taking the time to watch this today.